Hey everybody, welcome back to the Optometry Money Podcast, where I'm helping ODs make better and better decisions around your money, your careers, and your practices. On today's show, we're going to talk all about working as a 1099 independent contractor. What are the different tax and financial considerations that you need to keep in mind to help you prepare for life as a 1099 OD? I am your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors. Thank you so much for listening. I am excited to be here with you today. And should you be a W-2 employee or a 1099 independent contractor, this may be one of the first decisions you have to make coming out of school. As you're evaluating a contract offer, you're looking at a choice between the two, or it's something you're seeking out. Maybe you want to work as an independent contractor. Whatever the case, there are some important considerations that you need to keep in mind as you're weighing the pros and the cons between the two options. I had a conversation recently with an OD. She took a 1099 opportunity straight out of school. So this is her first job out of school, and things were going great. She was earning a pretty high income, and things were great all the way up until tax time. And she was shocked at the amount of tax that was due from her first year working as an independent contractor. And there are a lot of reasons why it gets to that point, to that shock or surprise. And imagine the stress of having to file your taxes for the first time as a self-employed, and then having to come up with all the cash to pay for that extra tax. It can be stressful, and it can be a surprise and a shock. And so if you're in the position where you're wondering whether you should work as a W-2 employee or as a 1099 independent contractor, there's some things that you have to think through when making that decision. And you want to know what to expect. You want to be prepared for whatever that decision entails. So today I'm going to go through the different financial decisions and considerations you have to keep in mind, and through some financial planning steps to help you prepare for that life, if that's the way you want to take your career. So number one, what are the differences between working as just a traditional employee or as a 1099 OD? Think about a W-2 employee. It's probably the most straightforward relationship you can have with an employer. You're going to get your set salary, whether it's a flat salary or a per diem rate or hourly rate. They're going to handle payroll on your behalf. You'll get your pay stub. You're going to see all your deductions taken out, all your taxes and benefits and everything taken out on your behalf. And it's all done behind the scenes. It's not something you need to worry about. You're just getting essentially your paycheck at the end of the month. Even things like 401k, they're handling those deductions. They're putting the money into your account for you. So those aren't things you really need to worry about. As a 1099 OD, what happens? Well, you get the full gross paycheck. You get the whole amount, which seems great because you feel like you have a higher pay. But the reality is you then need to handle all of those deductions and recreating those benefits all on your own. You need to handle tax payments and tax withholdings. You need to handle 401k deposits. You need to handle everything on your own once you get that paycheck. So there's more planning and more work and budgeting if you're going the 1099 route. So what are some of the things you need to keep in mind and plan for then if you are an independent contractor? Well, it comes down to really two things: taxes and benefits. Taxes are a big one. When you're a traditional employee, you pull out your pay stub, and what do you see? You're going to see income taxes. So it's going to be federal and state income taxes. And then you're going to see Social Security and Medicare taxes. It may look like FICA, FICA, it may be OASDI, or it may be separate Social Security and Medicare. On your pay stub, you're paying 6.2% for Social Security tax of your compensation up until $147,000 of income in 2022. And that number increases with inflation. So that's Social Security, 6.2%. For Medicare tax, you're going to pay 1.45% on all of your income. So you've got this total of 7.65% tax that's going into Social Security and Medicare. And then your employer, the practice you're working at, is going to pay an equal percentage on your behalf. So each of you pays an equal percentage into that. And then if you are a higher earner, So if you're earning over 200,000, if you're single, or if you're earning 250,000, if you're married, there's an additional 0.9% Medicare surtax. So there's an additional tax there, and your employer is required to start withholding that, I believe, once you start earning more than 200,000. So there's income taxes and also the employee taxes. When you're a 1099 independent contractor, you're responsible for even more. Yes, you're responsible for income taxes, federal and state. Federal is going to be anywhere between 10% to 37% marginal tax rates. Most of you probably will fall between 22 and 24%. Remember, that's based on your taxable income. So there's income taxes, and state taxes depend on each and every state. Some states don't have income taxes, so that's really dependent on where you're living. But there's also something called self-employment taxes. And whereas when you were a traditional employee, you paid about 7.65 total for those employment taxes, and your employer paid the same percentage. When you're self-employed, you are acting as both the employee and the employer. So you have to pay the total amount for both of those Social Security and Medicare taxes. So what does that look like? Well, if you're self-employed, the Social Security tax for you is 12.4% up to that income threshold. In 2022, it's $147,000. For Medicare taxes, that's a 2.9% on all of your income. So total, if you're self-employed, you're looking at an additional 15.3% tax, at least up to $147,000 in 2022, in addition to your regular income taxes for federal and state. If you're earning, let's say, a net business income of $100,000, that's a tax of $15,300. That can be a pretty substantial amount, not including that extra 0.9% if you're earning higher than that. So there's an additional tax burden on you if you're working as an independent contractor. However, there's a deduction that we'll talk about that comes along with that, but there's an additional tax burden. So that's something that you need to plan for. Secondly, in addition to that additional tax, you're responsible for making estimated tax payments. So when you were a W-2, your employer handled all the withholdings for you and sent it off to the state governments and federal government. You now are required, if you're self-employed independent contractor, to do quarterly estimated tax payments. And those tax payments are due generally on the 15th of April, June, September, and January. I am recording this on tax day 2022 in April 18th, 2022. So for this year, it's actually April 18th. Hopefully, you've all sent in your first quarterly estimated payment along with handling filing of last year's tax returns. But generally, it's due on the 15th of April, June, September, and January. And you need to be responsible for making sure that you're setting money aside and making those payments on time. Now, you also need to keep in mind, if you have W-2 employment, or if you have a spouse that works somewhere and has W-2 income, you can also just plan to manage withholdings through those paychecks. So that's something you can do as well. But if you're self-employed, generally, you're going to be responsible for handling your own quarterly estimated tax payments on time and making sure you're setting money aside from that paycheck to make those payments. But in light of those challenges, there are tax planning opportunities that you have when you're self-employed as a 1099 OD that you don't have as a W-2 traditional employee. For example, there's different ways you can file your taxes. For example, you can choose to file as an S corporation if it makes sense for your particular tax situation. So there's different filing opportunities and business planning opportunities that come along with that, because when you're a 1099 OD, you are essentially self-employed. You're owning a small business. You can also take advantage of ordinary and necessary business expenses, which can be deducted from your gross business income. That's something you can't do when you're a traditional employee. So, for example, licensing and continuing ed, your lab coat, but not your business attire, not your slacks and dress shirt or whatever it may be, but things like your lab coat, commuting costs, professional liability insurance, Those things that are directly related to your work as an optometrist are up for grabs as necessary and ordinary business expenses. So those are some deductions you can take advantage of. You can deduct half of your self-employment taxes. So we talked about how you have to pay both the employee and the employer's portion of your self-employment taxes. Well, you're able to take a deduction for half of that self-employment tax. It's not a deduction that ends up on your Schedule C if you're filing a Schedule C, but it ends up on your 1040 as an above-the-line deduction. So it's something that ends up on your personal tax return, but you're not going to see it within your Schedule C with the rest of your business, your regular, ordinary business deductions. If you're self-employed, if you're paying for health insurance, you can potentially take advantage of a self-employed health insurance premium deduction. And one substantial deduction that you have an opportunity to get when you're self-employed, when you're owning a business, is the QBI, the Qualified Business Income Deduction. The very basics of this is that it's a 20% deduction off of your qualified business income. And there are a lot of different rules and details of what goes into this calculation and who qualifies and whether you're phased out. What is qualified business income? What is QBI? It's essentially your net business income with some adjustments. For example, it's adjusted for your health insurance premium deduction. It's adjusted for your self-employment tax deduction that we just talked about. It's adjusted for your retirement plan contributions if you're self-employed. So it's essentially your net business income with some deduction, with some adjustments, and that's a 20% deduction based on that business income. And that can be a substantial amount and a substantial benefit for you to plan around. There are phase outs. So when your taxable income gets to a certain point, not including this deduction, I think for 2022, if you're single, when your taxable income gets to $170,050, and when you're married, $340,100, when your taxable income starts to get to those ranges without this deduction, then you start to phase out. The amount you can deduct actually starts to get lower and lower until you phase out altogether. And for optometrists, you're all what's called specified service businesses. So you have to keep this phase out in mind. But when you're self-employed, you get to take advantage and look forward to using this pretty substantial 20% QBI deduction. Lastly, there's also additional retirement plan options that you can take advantage of as a self-employed. When you're an employee, you're basically beholden to whatever your employer offers. They may have a 401k plan, but a simple IRA, or in some of the worst cases, they may have nothing at all. Maybe it's a new practice or whatever that may be. So you're sort of limited to what's given to you, what's available to you, or traditional IRAs, Roth IRAs, taxable investment accounts. So you're sort of limited as a regular traditional employee, but as a 1099 self-employed contractor, well, now you have more options to you. You can use a SEP IRA, which is essentially a profit-sharing plan where you can make a contribution of up to roughly 20% of your net business income. Or you can use something that's called a solo or individual 401k. And it's just like your 401k if you're employed at work. You can make contributions as an employee. So up to that maximum, roughly $20,000 amount as an employee. And also profit sharing contributions as an employer. So you have a much larger dollar amount you can put into it if you're able to, if you have the cash flow to do that, as compared to a SEP IRA or as compared to an employee in a practice. So there's some additional flexibilities there you can take advantage of. When you're self-employed, there's some different opportunities there. Even though there are challenges from a tax standpoint, there are some additional opportunities for you. The second thing that comes up in addition to taxes are benefits. This is another big one. When you're a traditional employee, what are some of the benefits you can look forward to? Well, there's health insurance, potentially there's 401k matching dollars or simple IRA matching dollars that the employer puts into your retirement account on your behalf. But there's also things that can get missed a lot of times. There's state, local, or federal benefits. For example, unemployment insurance, paid family leave. Those are all things that you don't have access to when you're a 1099 independent contractor versus being an employee. 401k employee match, things like health insurance or disability insurance, those are things you lose access to when you're self-employed. So those are things that you're going to have to recreate. Now, it is possible. You can get your own health insurance plan. You can enroll in your own solo or individual 401k or your own retirement account. So it is possible to sort of recreate these, but you're going to need to request or require a higher gross dollar amount for your income to make up for the fact that you need to do these things on your own. And some states do for those big benefits like unemployment or family leave. Some states do allow you to opt into it and to pay into those programs. I think California is one where you can pay into the unemployment insurance program as a self-employed worker. So some states do allow you to opt in, but by default, you're not contributing to those plans. So taxes and benefits are the two big things to sort of be aware of and to plan around. So what are some different financial planning considerations, and how do you get prepared to handle those things on your own? Well, the first thing I always like to bring up is, can you actually be classified as an independent contractor? I'm not an employment law attorney. I'm not an HR specialist. I am speaking beyond my knowledge here, but the IRS, the DOL, each and every state has very specific definitions of which workers can be classified as independent contractors. And why is this important? Well, if you're truly independent, meaning that you are setting your own hours, you're choosing which practices you're contracting with and working, and you're actually creating your own schedule and your own independent life. Well, that's one thing. But a lot of times what I'm hearing is that ODs are offered the opportunity to either be W-2 or 1099, and there's really no difference between the two of your actual work and function. Your work hours are actually still controlled by the employer. The type of and amount of work you're doing and the appointments that are set are still controlled by the employer. You're basically just getting paid two different ways. And in that case, I would ask yourself and do some research into whether you can actually legally be classified as an independent contractor, because there are laws around this, and a lot of it's to protect the employee from losing out on benefits, and especially things like workers' comp, paid family leave, unemployment insurance. And so this could affect negatively, if this were to be audited and looked into, this could affect negatively your employer and also you if you're making self-employed retirement plan contributions and different things like that. So these are some things that you want to be aware of and talk to someone that's actually knowledgeable in employment law and HR and things like that. But there are some things you can look at the IRS website, DOL website, all that stuff, your state. A lot of it comes down to control. How much control does your employer or the practice you're contracting with have over your hours and your work and the patient appointments that are set? How much control do they have over you? So that's one thing to just think about and for you to be comfortable with and know about. Secondly, how do we plan for taxes now that you are self-employed? We talked about the different challenges that you'll see as a 1099 optometrist that you don't see as a W-2. But we also talked about some different tax planning opportunities that you have. So how do we plan against those challenges and take advantage of those opportunities? Number one, let's talk about how to plan for quarterly estimated tax payments. How do you plan for those? Well, there are some steps you can take, especially earlier in the year or right as you file the previous year's taxes. So for now, we're talking about 2021 taxes have just been filed. How do we plan for 2022? The first thing you want to try to do is just to calculate your taxes for the year. Try to project out your taxes for 2022. Work with your financial advisor. For me, this is something I'm working with clients to project out. Earlier in the year, the better, or at least as soon as we have reliable tax numbers for the prior year. But work with your financial advisor. Work with your tax professional. A lot of times your tax pro, even if they're not actually calculating out taxes for the next year, they're providing estimated tax payment numbers for you. They're providing stubs for you to an amount to pay each quarter. So work with your professionals. But one thing you can try to do is actually project out your income, your deductions, your withholdings and your taxes and credits, and try to figure out what does that tax potentially look like for the next year. And then you want to break that tax up into four equal payments. That's going to include your income taxes and self-employment taxes, remember. And then each and every month or each quarter, have a process for getting that dollar amount out of your regular operating bank account and into a separate tax account. Get that out of your hands. Get used to the fact that that those funds are no longer yours and they now belong to the IRS or to your state government. So get used to setting that money aside each month or each quarter, getting it into a tax holding account. And so when the time comes on April 15th and June 15th, September 15th, January 15th, you have the funds set aside and ready to make those payments. You want to get ahead of these payments. You want to get ahead of the IRS. The last thing you want to do is get behind. Because what can happen is if you, let's say you forget to make any of these payments at all, and it's your first year and you're working as a 1099, you get to tax time, you haven't made any tax payments at all, you have a substantial tax bill that's due, you have penalty because you've probably underwithheld and you didn't make your payments on time. And so you now have to come up with the cash to pay last year's tax bill and make the current year's first quarter's estimated tax payments. So you're battling 2 years of tax payments all at once. So that's something that's a trap you really want to try to avoid if you can. And you can do that by getting ahead, setting money aside throughout the year, and getting those tax payments made on time. One question that comes up is, what if your income varies? What do you do? Like, what if you're not sure what your income is going to be? It could be higher, it could be lower. What if you really don't know? Well, the IRS gives you some safe harbors to plan for. These are some simple numbers you can plan for to at least avoid paying an underwithholding penalty. Number one is that the IRS says that if you file your tax return come tax time, and after you subtract out all of your other withholdings and all your tax credits, if you owe less than $1,000, you don't have to pay underwithholding penalty. Now, the hard thing is you really don't know ahead of time what you need to do to get to under that $1,000. So that can be up in the air sometimes. The next thing you can do is you can pay if you withheld or if you've made payments that are at least 90% of your total tax when you file your taxes, you don't have to pay underwithholding penalties, right? So if you target for at least 90% of your total tax, that's one safe harbor. The last one is if you withhold at least 100% of last year's total tax on your tax return, then you've met the requirements and you don't have to pay an underwithholding penalty. There's an exception here. If you are a higher earning employee or a higher earning independent contractor, if you're single and if you're earning at least $75,000, or if you're married filing jointly and you had an AGI, an adjusted gross income of $150,000, then you have to withhold 110% of last year's tax bill. But that can sometimes be the easiest harbor to shoot for, is you just look at your last year's tax bill. You can just base it off either 100% or 110% of that number. A lot of times CPAs or your enrolled agent, your tax preparer, when they suggest estimated tax payments, it's a lot of times going to be based on that rule, on that safe harbor. And then as you go throughout the year, as you get a better feel of what your income is going to be, you can update your tax projection with your professionals, and you can adjust your withholdings, your estimated payments. The goal at the end of the year, essentially the goal at tax time, is to get as close to zero tax due as possible. You don't want to over withhold or overpay and have a huge refund. You don't want to dramatically under withhold or underpay and have a huge tax bill. You want to try to get as close to zero as you can. So you can just adjust these payments as you go. And another thing is that it's total withholdings on your tax return. So if you have W-2 income, for example, or if you're married and your spouse has W-2 income, the withholdings from those pay stubs, those paychecks, counts towards these things. So if you wanted, you can plan all of your tax withholdings on the W-2 income, and you can adjust those withholdings to account for these rules. And you don't have to make estimated tax payments because you're doing it all on that W-2 income. So it all comes down to your total tax and your total withholdings and total estimated tax payments that end up on your tax return. The last thing I'll say here is this just highlights really the importance of tax planning. There is a substantial difference between tax preparation and tax planning. Tax preparation is all about looking backwards, looking at what happened in the last year, gathering your tax information and making sure you're filing your taxes in a compliant way. Tax planning is looking forward. It's proactive. It's looking at what's going to happen, making your best educated guess about what's going to happen over the tax year, and then planning accordingly, making financial and tax decisions to try to limit and lower your taxes, try to plan around any tax laws that are new or that are ending from the last year, asking yourself questions about what's changing over the next year. So it's really looking forward and being proactive and projecting your taxes and making good proactive tax decisions. So you really want to work with an advisor that's going to be proactive with you on tax planning, making sure your tax professional is involved, making sure your professional team's helping you to be proactive in your tax planning and not just reactive. That's probably the best way to help you plan for these things, especially from a tax perspective. And the next thing is how do you plan for benefits? Well, you can create, as I mentioned earlier, you can recreate benefits on your own, even if you're not getting them through an employer. You can use self-employed retirement plans. You can use a solo or individual 401k. That's an option for you. You can use a SEP IRA. That's another option for you. Simple IRAs are even available to you if that's what you want to do. So there's those things you can use and plan around, and those can actually be pretty substantial tax planning tools. The money you put into those end up as a deduction on your tax return. Or you can use the Roth version of those, which are after tax, but all of the earnings and growth and grows tax free. And as you get to retirement and you follow the rules, the money comes out tax free. So those retirement accounts not just simply help you plan and invest for your future, but they can be substantial tax planning tools along with everything else. Health insurance, you can buy individual or family health insurance either through a health exchange, through your state or through the federal government. I typically recommend working with a health insurance broker who really knows what they're doing. To make sure you're aware of your options and you're making the best decisions for you and your family, all based upon how often you go to the doctor, what are your medical care needs, what prescriptions are you using. So you really want to work with a professional who knows what they're doing and help you make the best decisions there for your family. And then lastly, surround yourself with good professional help and counsel, making sure you're working closely with your financial advisor, your tax professional, making sure you're working with either an attorney, working with someone to help you review employment contracts, and making sure you're well aware of your options and what goes into each scenario and each decision. For example, that may be an attorney, that may be your tax professional, financial advisor. There are career coaches who can help you sort through these decisions and review these contracts with you. For example, ODs on Finance has a service like this. I think Dr. Chris Lopez is the one that does that. So there's solutions out there for career coaching to help you review these decisions. Ultimately, make sure your professional team is working together for your benefit proactively and helping you sort through these decisions and help you to be prepared as possible. So those are some of the things to think about if you are a 1099 independent contractor. Okay, so let's wrap up here with some clear action items, some clear takeaways for you if you're going the route of a 1099 independent contractor. Number one, have a plan for estimating and paying taxes. That includes projecting out and estimating your tax for the year, either working with your professionals or using the IRS has a form 1040 ES to help you estimate this. Or if you have W-2 income in the household, the IRS has a withholdings estimator tool that may be helpful. I'll drop links to those in the show notes, and then have a system to help you move those tax dollars into a separate bank account each month. And then be sure to make those quarterly estimated payments on time in April, June, September, and January. Number 2, make sure you're getting properly compensated for the benefits you're losing out on as a 1099 OD instead of working as a traditional W-2 employee. Number 3, work with someone for appropriate healthcare coverage. Number 4, take advantage of the retirement accounts that are at your disposal when you're self-employed. And then number 5, surround yourself with a good professional team and good professional counsel. This includes financial advice, tax, legal, contract reviews, career coaching if you want to go through these contracts with someone. And not just for the financial and tax aspects, but also just the different work and career aspects of that contract. So, for example, non-complete clauses or non-solicitation clauses, things like that. So surround yourself with a good professional team, get help where you need it. And with that, we'll wrap up. If you have any questions on any of these things we talked about, or if you want more resources to help navigate these decisions, shoot me an email. My email is Evon, EVON, at optometrywealth.com. Or if you have any questions or topics you want to see featured on this show is for you, especially for the first half of your career, optometrists. And so just shoot me an email, let me know. In the meantime, we'll look forward to seeing you on the next show of Optometry Wealth Advisors. If you want to learn more about me, my firm, Optometry Wealth Advisors, or how I work with optometrists nationwide, check out my website, optometrywealth.com, and we look forward to seeing you on the next show. Take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.